The governor of the Central Bank of Nigeria, Godwin Emefiele, formally assumed office for a second term of 5 years after taking his oath of office today. Emmanuel Odiaka, fixed income and FX analyst, joins me to discuss this and for an outlook on Nigeria's fixed income and FX markets this week. Emmanuel, thank you for being on the show today.
Thank you for having me.
Well, so the governor has taken, well, it's not a new governor, has taken the oath of office for the next 5 years. And of course, there's been a lot of talk about, policy direction, what we can look forward to. And I've spoken to a number of analysts, and they've told me that, look, some of the policies they would call winning policies as it were, and if they're winning policies, don't change them. Continue as it were, especially as we're referring to the FX space. But in terms of what the CBN, the MPC has been doing, supporting those intervention schemes, notably the anchor borrower scheme, etc. Do you think that those are schemes that are going to continue? But let me hear your thoughts in terms of what we should expect or what your expectations are in terms of monetary policy direction.
Thank you. Significantly, the governor have always mentioned that the monetary policy direction would be that of price stability. I don't see that changing in this new tenure. Although we have seen a little bit shift from the contractional monetary policy tightening of keeping MPR at 14% to the last two MPCs where they cut rate to 13.5%. However, significantly, the held rate in the last MPC in May at 13.5, citing uncertainties in global economic meltdown and global economic growth. I think looking forward, the governor would, of course, be aware that there are significant structural issues that could derail going expansionary in terms of monetary policy, vis-a-vis the increase in minimum wage, and there is a likelihood from the budget that has been passed that there's going to be a tampering with fuel pump metering. And that is to say a partial removal of fuel subsidy, if not a total removal of fuel subsidy. So that could be a hindering and downside risk to monetary policy planning. I think with the inputs of the central bank authority in terms of soft loans to SMEs and significant aspects of the Nigerian economy to try and spur growth, I think that would continue, the intervention of the CBN, the anchor borrowers program, the RISE program. They are going into other, cotton is going to come into full to try to revitalize the textile industry. Okay,
so we're seeing that spreading across major key
industrial commodities growth. Okay. That would be retained, in my own opinion, especially when the MPC has noted in the last communique that banks are still unwilling to grow credit into the economy and mandated the Apex Bank to look at ways to reduce banks' participation in securities trading. Although we have not seen...
We haven't seen, obviously, how that is going to work or be structured, but what are you looking forward to? What would be a scenario in terms of how that could possibly work?
That is a huge statement, but the implementation is also very, very tedious, if I were to say. Why? Because the government also rely on banks' participation in its securities issuance, in which case banks are a major player in government security borrowing, and government needs this issuance and this process to support its budget processes. Do you think
perhaps the CBN may be looking for some kind of balance where, yes, the banks do participate, obviously the government needs that participation at the securities market, but finding that balance where the banks, yes, they participate, but not too much, just enough to also, also fulfill that role of financial intermediation in the economy?
I don't think there's going to be a platform or a way for whether the banks are too much into it or too little into it. Any aspect, in my own opinion, in the Apex Bank using a policy instrument to limit the banks from participating in government securities, it's going to be of negative significance to market and government on the whole. If I'm to go a little bit into it, I think the Apex Bank should use more of moral suasion to get the banks into lending than using policy direction.
Hasn't the bank done that in the past? It
well,
didn't work.
It's more of a structural problem. You see, the banks are also there to protect the interests of its shareholders, and playing safe will always be a priority when there are uncertain things in lending in the structural economy with the way it is.
Okay, what about, the relationship between the fiscal authorities and the monetary authorities? Do you foresee any the difference in this relationship going forward, or is it just going to be, the usual, status quo, where the MPC does more, well, of course, does some of what would ordinarily be done by the fiscal authorities? I'm talking about, some of those intervention schemes to boost the economy.
Well, the intervention schemes are going to continue. I don't think the fiscal authorities are in a lot of comfort right now to grow the economy. Already there has been shouts in major corners to temper the borrowing program or the borrowing that we have seen this administration go into. I think there will always be that partnership between the fiscal and monetary policy, but the Apex Bank will continue to hold on to ensuring that there's price stability in whatever support they tend to lend to the fiscal authorities. Okay,
let's quickly move over to, I think we have about 2 minutes left for the fixed income markets, what we can expect for the month of June, borrowing, of course, through the Debt Management Office, the yield curve, and what investors will be expecting from the DMO.
Okay, while I have tried to highlight a little bit of this significance, notable was the MPC communique, where it was mentioned, like I mentioned earlier on, that the Apex Bank looks at tempering how much relatively banks can access the securities market. Market is still all open ears to see if there will be some significant inroads into that policy statement. So there's been a little bit, we saw a little bit of a bullish market in May, especially after the announcement of a new tenure for the CBN governor. But with the MPC communique, market was muted. We have also seen significant improvement in OMO issuance. There was OMO today, and stop rate was just printed at 12.48% compared to previous, where we saw the Apex Bank allow market demand and supply, or demand to dictate rates printing out. So I think that balance will continue to be seen, where the Apex Bank tries to control its influence and yield returns on the curve, because this other aspect of foreign portfolio investors' concern on lower yields that may impact the iron yield window and significantly put pressure on the foreign exchange market. So I think those balances will continue to be put under consideration, whatever the Apex Bank wants to do.
Speaking about pressure, just looking at oil prices today at $62, and very close to our oil benchmark projection in the 2019 budget. And of course, that also has implications for the accretion of our reserves if we do see oil prices go lower. But, it's unpredictable. We could wake up tomorrow morning and see oil prices at, maybe somewhere around $65 per barrel. But, is it something, obviously, that the authorities will be keeping an eye on? And also, of course, accretion of the reserves.
Yes, certainly. It's significant to us in terms of accretion to the reserves, type price stability on the FX side. The ongoing war, trade war, tariff war between Mexico and USA, China is also significant to oil price movements. I think President Trump's pronunciation on tariff on Mexico was huge to the headwind we just saw in oil prices. That is a concern that is not within our hands, but I think it's a major significant aspect to monetary and fiscal policy pricing going forward. Okay.